Welcome to Global Signs. From Charlotte, North Carolina, we'll be speaking with Kelly Burton, Managing Director of Global High Yield at Baring Asset Management. Kelly, thank you for joining us today.
Sure, thanks for having me.
Thank you. Globally, some 10.3% of portfolio managers are women. In the US, that figure is 9%. What challenges did you overcome to become a fixed income portfolio manager?
Well, the financial industry as a whole is working hard to advance talented women into the higher ranks. At Barings, we launched 3 Barings Women's Networks in the US, the UK, and in Europe so that we can connect, educate, and advance women in our organization. In terms of my own career path, I have been fortunate to get a lot of support from peers, mentors, and senior leaders that have challenged and encouraged me along the way. I think it's been just the right mix of a hard work ethic on my part, but also being with the right firm as a good fit that has enabled me to move into the position I'm in today. Outside of that, I think it helped a lot that I was a research analyst for many years beforehand. I studied a lot of credit and I followed a variety of industries before I actually shifted into the portfolio management role.
Kelly, why are institutions pouring money into high yield funds? What's the attraction?
Well, I understand that retail investors probably have a good sense of stocks, but they probably are less familiar with high yield as an asset class. Simply put, high yield bond is a debt instrument of a company that is rated below investment grade by the credit rating agencies. Because it comes with lower ratings, it also comes with higher coupons for investors. The high yield asset class has received a lot of inflows this year following the market sell-off, but significant amounts of money do remain on the sidelines being ready to put to work into risk assets. Investors who understand high yield realize that it's an inefficient asset class at the end of the day, and it allows active managers like Barings to be able to exploit pricing gaps and earn outsized returns relative to passive strategies. For example, when ETFs are forced sellers in the market, because of redemptions going on, we are able to go out and buy discounted bonds.
In the high yield sector, where do you see the good investment opportunities?
There's a couple spots I would point out in particular, the first of which is fallen angels. This year, we've seen over $200 billion of investment grade rated paper fall into high yield. The rating agencies were pretty swift in their downgrade actions once COVID-19 really took hold and started affecting businesses. And what we do at Barings is we really integrate our high yield and our investment grade teams so that they can stay coordinated on what kinds of names could be falling into our space. And why we find that attractive is because as it's transitioning out of one index into another, it can come into high yield trading at wider yields or spreads relative to even double B peers. And often these fallen angels are really large, well-diversified issuers that have a lot of liquidity and levers to pull in order to maintain good balance sheets and service their debt. So we do really like that part of the space. Secondly, we were very constructive on secured bonds. The secured bond market was the first place issuers went when the market reopened in April. And since that time, we've seen a really healthy amount of supply in secured bonds. We like those particularly because they come with similar yields and spreads to the broader high yield market, but it also comes with collateral attached to it on the underlying assets that we're underwriting.
With companies under so much pressure this year due to COVID-19, what are your views on defaults? How do you manage risk?
Well, with the economic stresses we have seen this year, default rates have definitely come under the microscope. We've seen some concentration in defaults within the energy and retail sectors, and default rates have ticked up to around 5% in the US and about 3% in Europe. But we are very unlikely to reach the high levels that were estimated several months back when the pandemic really just began. The reason for that was we've seen lots of stimulus pumped into the market. The markets were very accommodative and open for issuers to come and grab liquidity through new deals. So because of the cash they were able to get through the markets, they should be able to really ride out this difficult period of time. In terms of managing risks, certainly certain sectors are going to be more exposed to the COVID-19 trends than others. For example, travel and leisure. So that's why it was really important for us to have our analysts spend a lot of time digging deep, running scenarios in their models, stress testing them to see just how many months that these companies could operate at depressed levels before they ran out of liquidity. These are the very same issuers that are going to be huge beneficiaries once vaccines are really put out into the market next year.
Now, what are your team's investment principles? Were there any changes during the pandemic period?
At Barings, we have a team-based approach to making credit decisions. We really take pride in our experienced research analysts and the rigorous credit work that they do. Our research analysts and us as portfolio managers, we work hand in hand to really understand company financials, get to know management teams. We discuss new deal flow in the market. Every day, we actually have an investment committee meeting that's all hands on deck. We discuss the new deals, market conditions, any inquiry related to the credits that we're monitoring. So it's a real good partnership that we have together between the teams. And so, as the pandemic took hold earlier this year, the one change was most of us went home to work from home about mid-March. And that seemed stressful, very different from our normal day-to-day working environment, sitting on a trading floor. But technology was resilient for us, and we've just maintained a lot of virtual meetings. We're on the phone every day, chatting on Bloomberg. What we miss the most, though, is seeing our clients in person. Virtual is not quite the same. So we do look forward to the day when business travel returns and we can sit down with our clients face to face.
Now, what is your U.S. and global financial markets outlook for 2021?
So we have come a long way, right, since the sell-off back in March. Broadly speaking, we've seen equities outperforming the bond markets, investment grade outperforming high yields. On a regional basis, U.S. and emerging markets have outperformed European indices. Clearly in Europe, we still have Brexit as an ongoing situation. And then as of late, they've been putting more severe lockdowns in place in response to the rising COVID cases. But what has helped us this year is all of the global central bank support that has been hugely accommodative. But outside of that, from the fundamental standpoint, the second quarter and third quarter earnings have come in better than the low expectations that were out there. And there's a variety of economic indicators that really tell us we are in the midst of a recovery. So what are some risks that we continue to monitor? Obviously, the COVID situation is very important. This latest wave is resulting in, again, restrictions on our mobility. But then on the positive side, we have good vaccine news. Those should come, into play in the next year, which are going to help a lot of companies and us just getting back on our feet in terms of consumer behavior. So as an active asset manager, we can look through some of this near-term volatility and look ahead. The money we are investing on behalf of our clients, we have long-term views of our asset classes, and this is why we've been able to outperform over a long period of time.
I know that your company doesn't allow for you to make stock recommendations, but can you share your views on promising sectors and investment themes?
Sure. So coming out of the sell-off, we began tilting portfolios more towards cyclicals and pairing the less yieldy defensive sectors. And part of our view there just stems from the fact that while we understand the pandemic is significantly affecting global growth, at the end of the day, it would be transitory in nature. We have a lot of high quality companies that we're underwriting that should be able to survive this at the end of the day. In terms of specific sectors, for instance, the automotive space had a lot of fallen angel activity this year. So we did start buying some of those assets before they even officially got downgraded into high yield. Within the automotive space, it's been a pretty amazing recovery in terms of sales. Also on the cyclical side, housing has been a big beneficiary through this period of time due to low mortgage rates. But also, as people were working from home, they started moving out more to the suburbs. So we've had a tremendous amount of home sales going on. Related to that, on the building product side, a lot of these companies are benefiting from the home sales activities and the remodeling efforts that people are doing in their homes. There's a lot of building product companies within high yield that we've participated in. Outside of some of the cyclical areas, we also favor technology, particularly within software credits. These companies have high recurring revenue streams, which makes them very cash generative. From a more cautious angle, I would say energy has been challenged. It's been pretty fraught with restructurings and bankruptcies on the smaller mid-cap side, and we continue to monitor some ongoing supply-demand issues.
Kelly Burton, Managing Director of Global High Yield at Baring Asset Management. Thank you so much for being with us today.
You're welcome. Thanks.
Thank you. Although Kelly feels that the pandemic is detrimental to global growth, she believes that it'll be short-term and that high-quality companies will survive. Sectors that she likes are the automotive industry, housing market, and companies that are connected to home building. Another area she favors is technology, particularly software companies. She remains cautious, however, on the energy sector, but believes that there are also potentially good investment opportunities there. This does it for this week's Global Signs. Until next week, please be safe and healthy.